Your revenue hit record highs last quarter, but your bank account doesn't show it. That's not bad luck. That's a leak. In the next 12 minutes, I'm going to help you find exactly where that leak is coming from. Not with theory, but a diagnostic audit you can run today that will show you which clients are building your business and which ones are quietly destroying it. But first, think about which scenario feels most accurate right now. Your margins feel thinner despite higher sales. Your team stays busy, but delivery feels inefficient. Clients keep requesting exceptions and custom work. And your calendar is packed, but cash flow feels tight. Keep that in mind. We're going to diagnose the root cause and give you a step-by-step plan to fix it. This is part of a series on building revenue infrastructure that actually scales. Now, today's diagnostic works standalone, but I'll connect the bigger picture at the end. So here's the core principle we need to establish. Revenue is a scoreboard. Cash is oxygen, and profit is the engine. Most business owners see revenue rising and assume the engine is strong. But you can grow revenue by adding work that pays poorly, drains your team, creates operational exceptions, and slow everything down. That's not growth. That's expansion without control. And here's what most people miss. The problem isn't usually your pricing. The problem is what it costs you to deliver. Let me show you how this actually works in real business. I keep hearing variations of the same pattern from business owners. We had our best revenue month ever, but it was also our most stressful month ever. That's not a contradiction. That's actually usually a warning sign. When revenue grows faster than profit, you're not building a business. You're building a job with more complexity. The math is simple. If client A generates $10,000 in revenue but costs $8,000 to deliver, and client B generates $8,000 of revenue but only $4,000 to deliver, client B is building your business and client A is consuming it. But here's the dangerous part. Client A looks more successful on your revenue report, so you go find more clients like client A. 6 months later, you're working twice as hard for the same net result. There are 3 common sources where cash leaks out of growing businesses. The first one is client drift. You slowly accept clients that are slightly off your ideal fit. The second one is the service complexity trap. You add services and options that multiply delivery cost. And the third one, delivery cost blindness. You don't know your true cost per client. Most businesses have at least one of these. Many have all 3. However, the good news is once you identify which one is hitting you, the fix is usually straightforward. Let me walk you through each one, and then I'll give you the exact audit to pinpoint where your leaks are coming from. Client drift happens gradually. You start with a clear ideal client profile. Then someone refers a client who's slightly different, but they have money. The project sounds interesting, so you say yes. Then another referral comes along that's a little different in another direction. Then another. And before you know it, you're serving 3 or 4 different types of clients, and each one requires a different approach. Here's what client drift actually looks like in practice. Your marketing has to be generic because you're trying to speak to multiple audiences. Your sales process gets complicated because you need different conversations for different client types. Your team needs different skills and training for each client segment. So your processes becomes full of exceptions and special cases. And most importantly, your delivery cost varies widely from client to client. Let me give you a specific example. I was working with a consulting firm that served both mid-market companies and small businesses. On paper, both client types were profitable, but the small business clients took 3 times longer to onboard because they needed more education. They required twice as many check-ins because they weren't sure what they wanted. And they needed 50% more revisions because they kept changing their mind about the success criteria. Same fee structure, completely different delivery cost. The mid-market clients knew what they wanted, followed the process, and referred similar clients. The small business clients consumed team energy and referred clients who also needed handholding. One was building the business, one was consuming it. This is the silent killer most business owners don't see coming. It starts innocently. A client asks, "Can you also handle this other thing?" So you think, "Sure." How hard could it be? So you add a service. Then another client wants something slightly different, so you add an option. Then another client wants a custom package, so you create that too. 12 months later, you have a service menu instead of a focused offering. And every item in that menu requires different expertise, different process, different tools, and different training. And here's the real cost of complexity. Every new service multiplies your onboarding complexity. Your team needs to know how to deliver multiple things instead of becoming experts at one thing. Your systems need to handle multiple workflows instead of optimizing one workflow. And most importantly, you can't scale any single service efficiently because your attention and resources are split. I see this pattern repeatedly. Business owner tells me, we can do anything for anyone. Now that sounds impressive, but what you've actually created is a business that does everything adequately instead of one thing exceptionally. The businesses that scale efficiently have what I call disciplined focus. They become known for solving one specific problem extraordinarily well. Their processes get refined, their team become experts, and their delivery becomes predictable. I know that complexity feels like flexibility. I've been guilty of that myself. But it's actually a tax on every operation in your business. This is where most business owners get into trouble without realizing it. They focus on price they charge without understanding the cost to deliver. So they keep winning deals that look profitable but behave like losses. Let me break this down with real numbers. You quote a project at $15,000, your direct costs are $3,000. Looks like you made a $12,000 profit, right? But you didn't factor in the actual delivery cost. How many hours will your team spend on onboarding? How many revision cycles will this client require? And how many check-in meetings and status updates? How much project management overhead? And how much administrative work for invoicing and collections? If that $15,000 project actually requires 60 hours of your team's time at a blended rate of $150 per hour, your true delivery cost becomes $12,000 total. $3,000 in direct costs and $9,000 in labor. Suddenly, your $12,000 profit becomes a $3,000 profit, only 20% margin instead of your 80% you thought you had. And if the client requires more revisions or more meetings than expected, even that small profit disappears entirely. Here's what I've learned. High maintenance clients can turn any price into a bad deal. The client who responds quickly, follows your process, and provides clear feedback is profitable at almost any reasonable price. The client who's slow to respond, changes requirements mid-project, and needs extensive hand-holding can be unprofitable even at premium price. Most business owners optimize for higher prices when they should optimize for lower delivery costs. All right, here's the diagnostic tool that's going to show you exactly where your leaks are. I call it Client Energy Audit. It's simple, it's fast, it's brutally accurate. Pull up your client list for the last 12 months. For each client, you're going to score them 1 to 5 on 4 specific criteria. The first criteria is true profitability. After you factor in all delivery costs, team time, revisions, meetings, and administration, is this client actually profitable? 1 means they're barely breaking even or losing money. 5 means they're highly profitable even after all costs. The second criteria is energy impact. Does this client energize your team or drain them? 1 means they create stress, confusion, and burnout. 5 means your team is excited to work with them and do their best work. The third criteria is process obedience. Does this client follow your established processes or do they constantly require exceptions? 1 means they need custom handling for everything. 5 means they follow your process perfectly and make your job easier. And the fourth criteria is growth value. Does this client create future value through referrals, case studies, reputation enhancement, or expansion opportunities? 1 means they're dead end. 5 means they're actively building your business. Now, add up their score. If they score 18 to 20 points, these are your ideal clients, and everything in your business should be designed to serve more clients like these. If they score 14 to 17 points, these are good clients with minor friction. Small optimization can move them to ideal. If they score 10 to 13 points, these are problematic clients. They're not building your business. They're preventing you from serving your best clients well. And the 4 to 9 points, these are margin killers. Every hour you spend serving them is an hour you can't spend building your business. When you run this audit, you'll probably discover something important. Your most profitable clients are also your easiest clients to serve. That's not a coincidence. And here's the typical 20-80 rule almost every business owner discovers. About 20% of their clients generate 80% of their profit and positive referrals, and the other 20% consumes 80% of their time and energy. That bottom 20% isn't just unprofitable. They're actively making it harder for you to serve your best clients. Once you've identified your margin killers, you have 3 strategic options. Option 1, reprice and reset. If the client has potential value but currently requires too much effort, you can reprice your service to reflect that true delivery cost. Here's a simple script you could use. To continue serving you at the level you deserve, we need to adjust our scope and pricing structure. Here's what that looks like and why. Now, most high-maintenance clients either accept the new structure and become profitable, or they self-select out. Either outcome helps your business. Option 2, systemize and exceptions. If multiple clients are creating similar exceptions, build those exceptions into your standard process. Create decision rules for what you will do, what you won't do, what triggers additional charges, and who has the authority to approve changes. The goal is to turn chaos into predictability. Option 3 is strategic transition. If a client is a true margin killer with no path to profitability, you respectfully transition them out to someone who specializes in serving that type of clients. This is the hardest option emotionally. This is often the most important for your business's health. Here's the key insight. Every hour you spend serving margin killers is an hour you can't spend serving ideal clients or finding new ideal clients. The fastest path to better cash flow isn't marketing, it's removing the leaks from your current client base. When you can focus your energy on your best clients, everything compounds. Your delivery gets better, your case studies get stronger, your referrals become higher quality, and your team becomes more motivated and effective. This audit reveals something critical about scaling a business. Growth isn't just about addition, it's about subtraction. The businesses that scale cleanly don't just acquire new clients. They systematically remove the limitations that prevent efficient delivery. When you serve fewer client types that serve them exceptionally well, several things happen. Your marketing becomes clearer because you're speaking to one specific audience with one specific problem. Your sales process becomes more confident because you know exactly who you're for and who you're not for. Your delivery becomes more efficient because your team develops expertise instead of constantly adapting to new requirements. And your case studies become more powerful because you're all solving the same core problem. Most importantly, your cash flow becomes more predictable because you know your true delivery costs and you're only working with clients who respect your process. When you're crystal clear about who you serve and how you serve them, profit follows naturally. Here's what to do this week. Run the client energy audit on your last 20 clients. Score them honestly on all 4 criteria and circle the bottom 5. Then ask yourself this question. What would change in your business if we stopped accepting clients like these? For most business owners, that question reveals the path to better cash flow without any new marketing. If you want the one-page client energy audit worksheet with scoring guide and action templates, comment audit below and I'll send it to you. And if you want help mapping this in a complete revenue infrastructure strategy, there's a link in the descriptions for the revenue infrastructure diagnostic. We'll analyze your client mix, your delivery systems, and give you a step-by-step plan to focus on your highest value opportunities. Now, if you want a complete picture of how this connects to building a business that scales, go out to the other videos in this series. Video 1 shows why most businesses build their systems in the wrong order. And video 2 reveals how 5% leadership misalignment creates execution chaos. Together, they give you a complete framework for revenue infrastructure that actually works. Links are in the description. And don't forget to subscribe so you get all the video series like this one. I'll see you in the next one.